Welcome back. You're watching HFO-TV. HFO-TV is co-sponsored by J.R. Johnson LLC, specialists in multifamily restoration and repair work. Gantry Incorporated, the nation's largest independent mortgage banking firm.
Hi, it's Greg Frick, HFO Investment Real Estate here again. We've got Mike Wilkerson back from ECONorthwest, Lee Fehrenbacher, one of our senior brokers as well. We're here to talk about the state of the downtown and Central City of Portland. I know there was a report done, kind of regional. This one's more specific about downtown and Central City. So, Mike, thanks for taking the time to come talk to us about that. First off, can we let's define what is Central City?
Yeah.
And then from there, we'll kind of expand as to, what's going on there.
Yeah, I think oftentimes people interchangeably use downtown and Central City as meaning the same thing.
Yes.
CBD is another way you hear it oftentimes. So I think for us, when we say Central City in the context of this report, we're using the city's defined geography. So it's 10 neighborhoods.
Okay.
Downtown is one of them. The Pearl District, Albina, Lloyd, Central East Side, South Waterfront, University District, West End going into 405 and all the way out to Goose Hollow. So basically what middle parts of the city, except really Slabtown is what I would say is excluded.
Okay.
Otherwise, it's pretty much what you would think of as the entirety of our Central City. And that's, I think, a helpful definition relative to other studies that are out there where they're saying, let's compare Portland to other places. And you're comparing, one zip code of our downtown to like all of downtown Seattle.
Right.
You're like, well, we got to get apples to apples here. And so part of the study was an acknowledgement that we want to get some relative idea of what's happening in our downtown recovery. And to do that, we have to think about our geographies. And I think we have peer regions that we've identified in the report. So looking at Denver, looking at Minneapolis, looking at Sacramento, looking at Milwaukee, and looking at Seattle, we can now say, okay, like what's happening here versus what's happening there versus just saying, where were we and we're not there anymore, and that's not that helpful of a conversation.
Got it. Okay. So based on what you've said, what did you find and discover in this study? I
mean, I think we start with what would typically be indicators when you talk about the health of a downtown, which is, office predominant. And today, I think is no surprise, we have a changing market largely driven by remote work and the pandemic, where office vacancy rates are just skyrocketing more than they ever have before. And this is not unique to Portland, right? Our vacancy rates continue to go up. And I think the challenge here to me is this isn't really a leading indicator. This is a very lagged indicator, because if you signed a lease pre-pandemic, you're locked in. You're waiting for the lease to expire. And so we're looking at this and we're basically seeing what's happening, which is as leases expire, people typically have three choices. One, going fully remote. And that's a small portion of that, but that happens. Choice two is re-sign the lease in the Central City if you were previously in the Central City. And there, what we see very clearly happening is most people are taking less space than they had before. Mm-hmm. They're not looking to save dollars. They're spending the same amount, but the flight to quality is suggesting they're moving into trophy and Class A properties, spending the same amount on rent because they understand their employees need a little bit of a nudge to want to go into the office. And so if the location isn't great, if the amenities aren't great, they're going to have a harder time doing that. So they're really trying to invest in that physical space. And so you're seeing, 30% less space, same dollars, or people relocate out of the Central City entirely. Right. And so, only one of those things is driving activity back into the Central City, which is the renewals, which are smaller. So really for us, when we're looking at that, what we're tracking is leasing volume. And we haven't unfortunately hit the bottom yet in terms of how many leases are actively signed in the Central City every quarter. Once we hit that bottom, then I think we'll have a better sense of, okay, we probably have 2 or 3 more years of leases that are largely expiring.
Coming up, but yeah.
Now we can see, okay, we're going to have millions and millions of square feet of office to absorb to get back down to that historic vacancy rate. What are we looking like here? And the number is not pretty. It's for sure more than 10 years. I think you would need some heavy programmatic support and investments to get conversion. But conversion is never the cure to the vacancy problem. It's just a little bit of a small blip on that, or some large scale relocations into the city, or I think what is the most likely, a realization that hybrid work doesn't mean you need less space per employee, right? Because why? What hybrid work means is your workforce is there now on Tuesdays, Wednesdays, and Thursdays. All the same people are still there. They're just not there 2 days a week. And so why do you need less space if all of your workforce is there? I think to me, the two sides to that are, one, we're working in different ways now. So we're working more collaboratively. We need less private office, et cetera. maybe that's the case for why you need less. But I don't know that that's clear for every industry. I think a lot of times it's the opposite. You actually need more private space because we're all working on Zoom and being more efficient with our time, less travel out of the office. It might suggest you actually need more space per employee. So I think until we kind of sort that out, everyone right now is playing, using the same playbook, which is just take less. Once we kind of get behavior of, oh, actually, you know what? We're growing our employment again. People actually don't like this. Maybe let's pivot. So I think for me, that's the most likely case on how you would get a quicker recovery, is that the space per employee reverses this decade-long trend of less square feet per employee that really even dropped further in the pandemic. If that goes back to where it was 10 years ago, that's probably your best way to get back to a stabilized vacancy.
But we're still in this transitional period where we're not sure how it's going to.
How long does that trend play out, do you think? Is it like, who knows, in terms of like businesses figuring out what is the right size?
A lot of leases, and early in the pandemic, right, owners were flexible. They're like, I'll take a 2-year lease.
Right.
Today, that's not happening because, right, what people want is they want to reposition spaces through tenant improvement. And no one's going to give you a meaningful tenant improvement allowance unless you're signing a 7-10-year lease.
Right.
And so while there was a short run, kind of short-term lease, now you're back into typical lease durations or possibly even longer lease durations. So I think people are going to be, again, locked in for a longer period of time. But the leases that are expiring, let's say a year from now, maybe we'll look at the lessons learned and say, oh, actually, we don't want that. But today, you're still seeing a pretty consistent trend here. I think it could pivot pretty quickly. The question then is, how long does that take to work its way through the market? That takes a long time, unfortunately. And once those preferences change.
Yeah, it's interesting because I remember the whole flight to open spaces, and then it went like, wait, this is not the best. We're not all collaborating. We need some back to privates. And then it was interesting as COVID, because it was also before COVID, it was the work share space. Hey, we'll work remotely. I'll get this desk today. You get that desk tomorrow. But then, okay, well, that's not great either. So I'm kind of with you. I think eventually it'll be a recognition that we don't need less space per an employee. Then you just might not all be there at the same time. Does that drive, usage? So, and then the amenity factor on flight to quality.
Yeah.
And the question becomes on all these central cities is, what do you do with these C and B type office properties that don't have the ability to give that amenity package?
That's 100% right. I think to me, the question is like, what is the new normal in terms of hybrid employees? You hear media stories on a daily basis. Company XYZ is pivoting and now requiring employees to go back. And I'm like, okay, that's anecdotal. What's actually happening in aggregate? And we have really good survey data now that goes back to pre-pandemic and monthly says, how many days a week are you working from home? And that's 30% of the time is basically the answer today. 6 months ago, it was 30%. 12 months ago, it was 30%. Okay. 18 months ago, it was 30%. Yeah. And so I'm like, do we have more media narrative today around return to work than we did 18 months ago? 100%. We're hearing bombardment with that. But then you look at the data and you're like, well, I don't see that. And so why is that happening? And the answer is either maybe those companies are doing that, but some policy companies are actually going the other direction and you don't hear the narrative around that. Or it's such a small part of a limited subset and people already at that company probably were doing that already, right? If I'm an employee and I look at my employee and I'm an employer and I'm like, my employees are already in the office 5 days a week, well, I should just make that the policy. But if like nobody wants to be in the office and I'm trying to go the other way, I'm not, there's probably a little bit of path dependency there. I'm saying like, oh, I want to go back to my old policy of 4 days a week because people already want to do that. But if your employees absolutely don't want to do that, that's a pretty bold management decision to say, I'm going to do something that none of my employees will appreciate, because what will likely happen, we have very strong labor market conditions today. So again, just a recognition that this is pretty settled preference in terms of employees, and it's not likely to move meaningfully. I think when we look at our downtown recovery, what that's suggestive of is continuing to compare ourselves to pre-pandemic trends is not helpful, because the new normal is very different than before. And so we should be anchoring in what's happening today and tracking the trend of what's actually happening. We should also look at the mix. So we can look at foot traffic by residents and visitors and employees. And we can look at the intensity or density of the foot traffic to understand like what is a relative activity level across our central city. And so for us, when we do that, I think we get a very different picture than some of the media that's been out there on Portland ranking dead last in terms of recovery. That may or may not be true depending on the methodology, okay? But putting that aside, the recovery actually has been meaningful. If we look at all of 2023 in our central city compared to 2022, we had 14% more trips
to central city.
relative to our peers, that's better than Denver, better than Sacramento, better than Milwaukee.
And that's everyone. That's residents, office workers,
foot traffic.
tourists.
Yep, all of it. And because that's what I think today is what matters. It's not office only centric use that we used to fixate on as the indicator of matter. Today, yes, that still matters, but that's less important,
Right.
Because foot traffic was very different. In the pre-times, our central city employment foot traffic was 30% of all foot traffic. I think people assume that was much higher, like 50%. It was never 50%. It was 30. It dropped to 24. And so again, from a relative basis, it was never the most important factor.
It was just one of them.
It was the only place we had data. We didn't,
Right.
Foot traffic data literally didn't exist. This is all cell phone, new technology data that didn't exist before. And so if we had that data before, I think we would have had a better understanding of what actually drives a successful, thriving central city. And yes, office is important, but that wasn't ever the key driver of our success as a region. It was that we had a mix. And so getting at the mix, I think, is more important, where we can say, what does our mix in our central city look like relative to these other places? And again, that's where we see Portland is not unlike other places.
In terms of the mix.
When we look at
what our uses
peers, 100%, we're a little bit heavier into residential. So that's a positive sign. I think today you want to be less reliant on employment because that's really hard to move the needle. You could move the needle on residential. You could move the needle on visitors. The question is, where are the visitors coming from? Are they rest of your region, or are they like tourism type visitors? That's an important
So from a
distinction.
central city side, we have less dependence on office, so to speak, versus some of our peers in terms of
a little bit less. But I would characterize it as we're all pretty much in the same boat.
Yeah.
And so again, we start to think about, Portland is very different. Our downtown is a ghost town. We have no employees. I'm like, it's no different than other places.
Right.
So I think for us, the question going forward is, where are the opportunities for more targeted kind of changes? How can we introduce a different mix of uses? And for us, we already have a relatively strong mix of residential to job. So job to residential ratio is one way you can think about that. If we take all of our central city, we have 4 times more jobs than housing units.
Okay.
And there's no desired number here. It's not like 1-to-1 is the thing you want, or it's just understanding that this is a pretty good mix, because other than Milwaukee, which tips into actually a lot of residential neighborhoods in their central city, is a little bit lower ratio. But other than that, we have a better balance in Seattle, Denver, Sacramento, and Minneapolis. So as we think about our regional competitiveness going forward, we already have the thing all these other regions want, which is
a
diversity of that. And you look at our neighborhoods, that's why. You have South Waterfront, West End, Goose Hollow, Pearl are almost all 1-to-1. So what would be a predominantly residential neighborhood in other places, we actually almost have a 1-to-1 mix already. Our downtown's on the other side, though. We have 20-to-1. And so for me, this is yes, maybe introducing more jobs into the rest of our central city, but it's equally about taking 20-to-1 ratio in downtown, 7-to-1 ratio in Lloyd and Central East Side, and getting that, let's say, closer to 4. And the way that you do that, right, in our downtown is challenged. There aren't many vacant lots left.
Right.
So what you're talking about reasonably is either conversion, demolition, and maybe some infill to the extent it exists. And again, we're not going to get to 4. That's not the goal here. Right. The goal is to say, what does our mix look like? And the mix is so disproportionately into office, and we know that that's not coming back. That if we want to increase our foot traffic activity, the answer is not return to work. The answer is targeted interventions for activations, events, et cetera, and more residential. And that's going to get you back to a more thriving, kind of consistent look and feel of downtown.
But again, that's just the downtown. I mean, that's where I think when you, on the press side, you hear about Central City, I think they look at it, you'll hear it about, nobody's there. They're really just looking
They're talking about downtown only, not Central City.
Right.
That's the distinction.
And that's a distinction. And I think, because we'll hear that as well, is we don't have a lot of housing in our downtown compared to some of the other cities.
And my answer is no, we have more than anyone else.
If you take the whole...
If you take a broad view of what a central city is.
Right. Is that ratio for downtown 19-to-1, I mean, is that similar to what you would find in
other places? It could be even higher in other places.
Yeah, okay.
Partially because, our overall density, let's say, of our towers is actually relatively low compared to even Denver, Minneapolis. They have a lot of corporate headquarters, right? Big, huge, tall buildings. So, we're not out of line, but we're, again, a little bit on the lower end, even in our downtown in terms of that. And what we see when we look at our density of our foot traffic, our density is not actually that high. I think we think of ourselves as a very walkable place, but that's not the same as actual feet on the ground per acre per month. Seattle's Central City is about 5,000 trips per acre, which is basically a Portland city block, right? Per month, 5,000. We're at like 2,500. And our most dense active place is our downtown. It's at like 3,500. So even our most active place isn't hitting kind of the average of these other places. So again, I think just a point of reflection to say, yes, we are very walkable, but that's different than saying we have a really high intensity of use. Right. And again, getting at other ways to change that, I think is an important kind of takeaway from the report.
Interesting. So it's probably not as bad as, it's portrayed in terms of where we are in the recovery. We have some uniqueness in the way we're, spread out in terms of the city, in terms of what you can do.
Yeah.
Is kind of going to be the challenge moving forward.
Why does it feel so, vacant down in the downtown core then?
I think
because that sounds very positive. But I think, you talk to anybody about the dynamics of downtown Portland and you'll hear a different story, right?
Yeah, again, it's the relative versus the absolute. You would hear the very same thing in other places, but most commercial brokers, let's say, in this community only work here. And so you're just like, this is different than before. 100%, this is different. Yeah. But if you went to a broker, now, the second point I would say, which is more unique to Portland, and I think is a big potential headwind, is our small block face size, to me, is a real challenge here, right? Why? We have much more active facing frontage than, let's say, Seattle, with their blocks being basically 4 times. They have
like super blocks.
They have a quarter less actual external facing. So when we have a retail challenge, that's very visible. You might see many blocks with nothing happening, whereas in Seattle, relative to the intensity of their uses, they have less active. They have much more private space to deal with. But from an active public realm, when Portland was doing very well at its peak in terms of attractiveness, tourism, et cetera, that was a huge strength, which is, this is a really walkable place. Look at all these amenities. Right? It's more vibrant. Yeah. The counterpoint to that is when things aren't well, we feel and look more challenged because we have more actual public realm
interesting
to deal with. And that, I think, is, again, a big crucial takeaway here is, we need to think about that because this is not the same as every other place.
Interesting. Any other big kind of aha moments in terms of this study? And like I said, you hear the narrative in the press versus kind of what's actually going on. And, we all know that there's a lot of times there's some, trying to just kind of get headlines. But was there something that kind of shocked you a little bit in terms of looking at this that you were surprised to find?
I think the biggest takeaway to me was that the assumption that we have a very walkable place, that means we actually are very, let's say, crowded and or intense or dense in our use. And when we look at our peer regions, and again, I think all of the peer regions are at that highest end nationally in the distribution, right? Like, I don't think we're talking about us being below the average. I think we're all at that tail end. But the fact that we're not ahead of them, I think, was a little bit surprising. I think the other thing that's maybe useful is just, some of the targeted policies we're seeing now are geographic based. So you see the business incentive credit for lease renewal, right? This type of data can be really helpful in saying, like, we're seeing different performance within our central city. Let's track this relatively real time so we can understand what's actually happening on the ground. And do we need more interventions in some places or different types of interventions in other places? So to me, that's part of the value of this too, is being able to do that much more targeted versus saying like all of the city is the same or all of the central city is the same when we know it's not exactly particular when we're talking about public realm.
Right. We also maybe neighborhood by neighborhood, maybe even block to block in terms of what you need to do to activate and get that thing re-engaged. So yeah. Okay. Well, thanks for sharing that one. Again, thanks for coming in. I know you're really busy, but it was great and enlightening. It's not as bad as the press says in terms of what's going on, and there's some uniqueness to our downtown. But when you take the whole central city, we do have some advantages there. So thanks, Mike, for doing that. And
we'll happy to come in
next time on HFO-TV.
Our entire office specializes in multifamily real estate, making HFO the largest multifamily brokerage in the Pacific Northwest. Your success is our passion. Build your legacy with HFO. Call 503-241-5541 or visit our website at hfore.com for more information.